The Strategic Investor's Lens, Cracking the Value Chain of a Wealth-Generating Company by Niketan Gangade, Strategic Wealth Mentor Arthniketan. The stock market doesn't reward late realization. It rewards early conviction. In investing, timing is everything, but not in the sense of gambling. Timing is about knowing where a company is in its value creation journey and entering before the crowd sees the full picture. Most retail investors chase prices. Strategic investors, they chase value before it becomes obvious. Let's now break down with surgical precision the value chain of a company and where you as a rational investor should look to trap opportunities. The value chain of a wealth-generating company investor's perspective. 1. Strategic intent, visions, narrative, capital discipline. This is the earliest stage, usually invisible to the public eye. Here, the company is reshaping its direction. New CEO, new product line, strategic acquisition, or pivot into a new market. This is when the seeds of transformation are sown. What to track? Promoter interviews, investor presentations, AGM notes, boardroom changes, CapEx announcements, R&D increases, moats being created, not just protected. This is where conviction beats consensus. The crowd won't believe yet. The numbers may still look average, but strategy whispers before profits scream. Best time for strategic entry, accumulation, small staggered. 2. Execution phase, order book plus client wins, cost control. Here, strategy begins converting into reality. This is the proof of concept zone. You'll notice rising order book, key customer wins or export orders, capacity utilization increases, debt restructuring or working capital efficiency. What to track? Quarterly results footnotes, investor con calls, volume expansion, margin expansion, management guidance versus delivery. This is where smart money starts positioning, and stocks still may be in a tight range, consolidation phase before breakout. Best time for aggressive entry before breakout. Hashtag 3, financial inflection, revenue plus EBITDA plus PAT growth begins. Now comes the visible growth stage. The financials catch up. Quarterly YY numbers look strong. Market starts taking notice. ROCE improves. Debt equity ratios drop. Margins stabilize. Guidance improves. This is the confirmation stage, where even conservative institutions start to notice. What to track? Operating leverage kicking in. Growth in top line followed by bottom line. Consistent QOQ improvement, not one-time jump. Cash flow from operations turning positive. This is often where breakout happens. Price runs ahead of earnings here. The classic PE expansion zone. Best time for momentum participation plus riding the wave. 4. Market euphoria, media coverage plus analyst upgrades plus high PE. The story is now in public. Everyone knows. You'll see. TV coverage, analyst upgrades, retail participation explodes, valuations stretch beyond fundamentals. At this point, you're no longer early. You're at the party. What to track? Insiders reducing holdings. Unrealistic price targets, excessive option activity, F&O buzz, PEG ratio, 2.0, paying too much for growth. This is where amateurs enter. Smart money starts distributing slowly. Risk-reward deteriorates. Best time for profit booking or trailing stop loss. 5. Maturity or saturation, flat revenue plus margin pressure. This is when growth fades. Company may still be good, but returns now reflect stability, not expansion. You'll notice flat to low growth, market share erosion, new competitors, higher CapEx for smaller results. What to track? Decline in volume growth, margin compression, higher working capital cycle, increase in employee costs with flat sales. Here, the company may still pay dividends, but compounding is gone. You're parking money, not growing it. Best time, rotate to new stories. So where is the smartest entry point? The answer? Between stage 1 and stage 2. That's where valuations are still reasonable, strategy is becoming action, market hasn't fully priced it in, risk reward is the best. The secret is buy when strategy becomes execution and sell when execution becomes narrative. Final notes, the strategic investor's edge. Don't just look at price. Don't even just look at profits. Look at how profit is created and what lies ahead. Here's the true edge. Understand the value chain of growth before the market reacts. Act when others are still doubting, not after media confirms it. Focus on what is improving, not what has improved. The market is a weighing machine, but with a delay. You win when you know what it will weigh next. At Arthniketan, we don't chase trends. We decode strategic signals. Create conviction, build clarity, compound capital. By Niketan Gangade, founder, Arthniketan, the home of smart capital. Wealth isn't hidden in chaos. It's embedded in patterns. Learn to see them.